I'm going to talk about what lessons can we learn from microfinance crises, and specifically in India. But I'm also going to have some reflections on Bolivia. So I want to address the questions: what went wrong, why did it happen, and what kind of resolution are we seeing? And I'm going to take an evolutionary view. I've been thinking a lot about evolution. Maybe I had a recent visit to the Museum of Natural History or something. Not quite sure, but the giants of Indian microfinance are increasingly looking to me like Tyrannosaurus Rex, Brontosaurus, and Triceratops, and I'm wondering whether they're dinosaurs. So. I'm thinking about this in evolutionary terms. So I'm going to start with the primordial soup. So the primordial soup is what the antecedents are, where the life came out of the primordial soup but all the ingredients were there for it to emerge. So what in India were the ingredients that were already there that ultimately led to both the growth of microfinance and the crisis? First, of course, India has the most poor people in the world. 1.2 billion people. Their census numbers have just come out, and it's now 1.2 billion. And although they've made strides, considerable strides in the past decade, they still do have the most people who are living under $1 a day in the world. India is an unruly democracy with a free press. I think those factors, and I'd say the Philippines maybe has some of the similar characteristics in that respect. Other characteristics of the political scene in India is a very strongly socialist way of thinking, a strong socialist history, a very strong welfare orientation towards the poor. Third is related to that socialist system or socialist way of thinking is a nationalized banking sector. So during the years leading up to the 1990s, for several decades, India had a fully nationalized banking system. It really did not have any private banks. All the banks were owned by the government. And so that really has a very different kind of banking sector, one that is basically carrying out the dictates of the central government. And finally, you have some traditional features of the society. Debt slavery has an ancient history and a very shameful history within India. Gender discrimination is strong in India, and so I think those are some of the kind of underlying ingredients that were in the culture, in the politics, in the situation facing India. So now we're going to just sort of move up in time, several million years, to the period in which the dinosaurs began to rule the world, and that was allowed to take off because of reforms in the 1990s. And we all know Prime Minister Manmohan Singh as the originator of the reforms in India that took India from the socialist period into a much more capitalist-oriented period. And that one of the reforms was to really open the financial sector, allow private banks to start going. And so what emerged at that point was a Reserve Bank of India, which was still really oriented towards serving the state banks, but yet at the same time had the job of allowing the private banks to begin to operate. And you need to know that the state banks, by and large, were money losers. And they were, before, as you would normally expect, sort of in a socialist setting, they weren't very good on collections. Were giving loans in strongly politicized for strongly politicized reasons. And so you had a very weak state banking sector, and the RBI then trying to promote the private sector. But a lot of skepticism by the general public and by the political scene, who really preferred the state banking sector and were more comfortable with the state banking sector. So you have this dichotomy going on. At the same time, then, another thing that happened was the development of the self-help group movement. And the self-help group movement became the adopted program of the Reserve Bank and its agricultural bank, NABARD. So the self-help group movement was done through the state banking sector. And so it grew up with the explicit support of the Reserve Bank. However, so that's one side, is all this state-supported financial sector development. But at the same time, what was going on in India with the economic reforms is the rise of social entrepreneurship, and many people in India with strong social motivations, and a lot of people coming out of with great private sector business experience were starting MFIs. And you look at India today, and it's really a picture of amazing entrepreneurship, and some of that entrepreneurship really rubbed off in the fact that I think India is really blessed with some great social entrepreneurs. So they began creating microfinance institutions, importing their models mainly from Bangladesh, since it was essentially the closest thing, the closest reference point. So that's great, and they were growing, and they were highly capable and motivated people behind those MFIs. But what happened is that they were not incorporated into the policy framework. They were really orphans. The whole MFI sector was an orphan sector that the Reserve Bank was paying very little attention to. And also the Reserve, as a result of the lack of trust by the Reserve Bank in the microfinance sector, meant the restrictions on what they could do. So they were not allowed to offer savings, even though the microfinance institutions that became finance companies were still not allowed to take savings. Monoproduct, without much supervision, they were allowed to operate with very weak governance, very strongly founder-dominated. And so that sector began to grow and chase the cult of scale. So if you look at, then we move into what I call, at the end of the dinosaurs, there was an asteroid that came and did something to the earth, and they all died. So the Indian microfinance sector was hit by an asteroid of their own making. And I'd like that Indian microfinance slide now, because the things that then started to come together to create the actual crisis, I think the cult of scale is very important there, and that was, I think the cult of scale is partly because of Indian perceptions of we are the country with the most poor people, and so if you're going to talk about a client base of 100,000 clients in India, that's not relevant. You have to have millions before you're relevant. And that cult of scale then was driven even harder by the entry of private equity into microfinance, as well as by the priority sector lending policies of the central bank that directed the state banks to lend money to microfinance institutions. So I don't know if you can see it very well, but I can just read off some of this. During the last 2 years before the crisis, the amount of growth was really astronomical. You can see there, this is the SKS is the biggest MFI. It's the block on the left. Spandana, Share, Bandhan, Asmita Basics, Equitas, etc. These are the top 10 microfinance institutions. These are all commercial institutions that have become finance companies. And if you look at how fast they were growing, SKS added 4 million clients during the 2 years between 2007 and 2009. Spandana added 2.5 million. Share 1.3 million. So if you just think about new clients, that's just new clients. That's not outstanding. 4, 5, 6, 7, anyway, it's like at least 10 million new clients being pulled into the system in just 2 years. So this is the pursuit of excessive scale. And what were they doing? They were locating branches in the same places. So first movers were moving into new branches, into new locations, but second movers were saying to themselves, oh, well, so-and-so moved there, so that's a good location, I'll move there too, and sort of a shortcut to not having to actually do the market research to figure out whether there was a good area. Politically, the south of India is a bit more receptive to microfinance than the north, and so most of this growth was taking place in the south, with Andhra Pradesh really turning out to be the state in which the sector was by far the largest. But if you can imagine trying to incorporate 10 million clients in such a short time, you're going to have a loss of standards, and you're going to be taking some shortcuts. So think about how many staff people are required to be brought into the system in order to process that many clients. And in order to have staff that really work well, you need those staff to develop the corporate culture to really understand the values and operating systems for these institutions. And when you're incorporating so many people so fast, that's very, very difficult to do. And one of the particularly bad practices that took place was the use of agents as to draw clients in. So agents that were either unpaid or paid, but sometimes not quite official, but were. One of the ways that this happened was through group leaders. Some of the group leaders would then go out and recruit new groups. It doesn't sound like it's so bad, but it is something that always tends to lead to uncontrolled growth. At the same time, there was a philosophy within the Indian microfinance sector of zero tolerance for default, and so very harsh collections practices in terms of you have to stay at the group meeting until all of the loans are here, even if it takes 5 hours of all sitting there at the group meeting until that happens. And this kind of collections practices was actually, as Stuart Rutherford pointed out recently to me, was that actually drives people into multiple lending because they know they absolutely have to pay the loan back, so that's going to drive them to go look for another lender, even if they know that that's not a good idea for them. So that was starting to go on in a big way, and then you have the suicides. Now the suicides, there are, I think, something around 50 suicides that have been attributed to microfinance in Andhra Pradesh. And just to note that the idea of committing suicide as a result of bad debts has a hundreds of years history in India. So it's not like, oh, this is something that suddenly popped up associated with microfinance and has never been there before. The difference is it's something that happens every year with the agricultural harvest. The difference is that it had never been, this phenomenon had never been associated with microfinance before. But it was in this year, and there's a lot of dispute over how serious that connection really was. Some people say most of the people who committed suicide did not have MFI debt, only a few did. Other people say no, it was a bit more than you're thinking, but it certainly was not, it wasn't clear that this was some new thing that happened as a result of this. But the press took it up and really made a lot of political mileage, or a lot of press mileage out of the suicides. And this all kind of connects in with the rivalry between, as I mentioned earlier, the self-help groups and the on the one side and the MFIs on the other side. So the self-help groups are what you also need to know about the self-help groups is that there's a giant World Bank project in Andhra Pradesh that supports the government of Andhra Pradesh to develop self-help groups. And the leaders of that project have had a strong hatred of microfinance institutions for many years because they take clients from the self-help groups, because there's been a migration from self-help groups to MFIs because the MFIs actually offer better service more quickly, more reliably, and so the self-help groups have lost clients, and the political leaders and state government leaders have wanted a way to essentially attack the MFIs. And this is what happened I don't know if you remember, but there was a crisis in Andhra Pradesh in 2006, and this was what was driving it. And so now what happened again is when the suicide started to happen, and the multiple lending that was going on was much, much more than it was in 2006, the crisis came back, exactly the same crisis, the state government moving against the microfinance institutions in a much stronger way. And so what then has happened? First, the state, I don't know if I need to go into the details of what happened. The state government put a law in place back in October that really made it very difficult for the microfinance institutions to keep going. And then the Reserve Bank created a committee called the Malagam Committee to study what should happen. The Malagam Committee made its recommendations, and now the Reserve Bank is then deciding whether to implement the recommendations of the Malagam Committee. That should be happening right now as we speak. This first couple of weeks of April, we're expecting to hear the RBI's outcomes. But what has been recommended is not that different from what we see already in the sector. But I'll come back to that. I guess we're looking to what's the emergence, what's the new species. You know, after the dinosaurs disappeared, mammals came along, and a different set of species, hopefully more resilient, but I'm not sure. So what's the new species that's going to be in India? And it's very much too soon to tell. Clearly the Indian policymakers are interested in financial inclusion, but they tend to see the financial inclusion once again through the state bank lens, and they're interested in transactions and mobile banking and things of that kind, and not necessarily seeing microfinance institutions as a key player in financial inclusion. Under the Malagam Committee, they are talking about creating a special category of finance companies that are MFIs, and that's a very positive development because they haven't had that before, but they still are not looking, it still looks like a dinosaur. It's not taking savings. They are talking about implementing an interest rate cap. And so what would be the recommendations that have been coming out would result in an MFI sector that can't develop, because it's very much saying microfinance is this group lending product only, and you can do MFI, you can do group lending microfinance and be an NBFC MFI, and that's it. So institutions that are interested in giving their clients a broader range of products and doing individual lending, and especially interested in offering savings, no, that's not part of the deal. But the question is the most hopeful thing that I've heard recently is that the RBI regards these Malagam Committee recommendations as a quick fix to get the politicians off their back, but that they will be looking for a longer-term solution that's more kind of holistic and helpful. So that's the story in India. And before, what I want to do is just to reflect briefly on what are the lessons we learned. But before doing that, I want to just quickly talk about Bolivia. Because Bolivia had its own crisis of microfinance. It was in 2000, 99, 2000, 2001. And the Bolivian crisis had different origins. It was really because of the entry of consumer lending with a slightly different lending model, but and a model that really wasn't very well suited to Bolivia. But encroachment directly on the microfinance clients. So as John was saying earlier today, people were saying, if you've got a loan from Banco Sol, we'll give you a bigger loan. And we won't, we know already if you're a Banco Sol client that you're good, so we won't bother too much with the underwriting process. No, this isn't the right one. The sacking of Banco Sol, that one. So this was under the crisis in Bolivia was similar in that you first saw a dramatic growth, the doubling of the loan portfolio, the aggregate loan portfolio in a very short time, then a recession. And the recession, that saying of when the recession happens, then we know tide goes out and we know who's been swimming without a bathing suit. So you saw the weaknesses appear when the recession hit, and the weaknesses were too many loans to too many people with insufficiently good underwriting. That led to debt protests and organized political protest movements that became violent in a couple of places. And I just want to show you pictures from the sacking of Banco Sol. And this is just one of the events that happened through this, but I think this really gives you the sense of how devastating the Bolivian crisis became. So these are protesters. The red building there is Banco Sol. These are protesters who are getting violent. Here they've taken all the computer equipment out of Banco Sol. They're putting it in the middle of the street, and they're trying to burn it. They're burning the computers. I didn't know computers burned, but I guess if you put them together with some chairs, they do. So the soldiers had to be called in order to deal with this. All those papers all those, whatever. Here's the soldiers have then gone inside the branch, and these are the protesters that have been handcuffed and made to lie down until the soldiers get the whole thing under control. But you can see that already the whole branch has been trashed. It speaks for itself. One more. Go ahead and cycle through. This is the aftermath. Basically, a couple of branches had to be completely gutted. So when I first saw those pictures, I started to cry. Because, how is it that we have been working all this time to provide financial services to low-income people, but because we think it's a way to help people make their lives better, and this is what happens? So, what's the lesson from? Before looking at the lessons, I do want to say that the Bolivian crisis has not killed off the Bolivian microfinance sector. It is now stronger than ever. Banco Sol is a very, very successful institution. It suffered a couple of years that were quite difficult, but after that, it recovered, and the whole sector is quite strong now. And although it's number 3 in the economists' ranking behind the Philippines. But the story of how they recovered, we'll talk about that a little bit later. But so I'm really going to leave you with the negative lessons of why do these kinds of crises happen. Clearly, there are vulnerabilities involved whenever you're talking about lending to low-income people, and I think these vulnerabilities are ever present, and we've seen them pop up again and again. We've recently seen them pop up in Bosnia and in Morocco. They popped up previously in South Africa as well. So everywhere around the globe we've had these kinds of crises. So we can pretty much know that this kind of situation is endemic to the industry of lending to low-income people. And I think there's maybe four things that are vulnerabilities whenever you're involved in this kind of an industry. One is the overlending problem, and I think this is you can in order to avoid overlending, you have to restrain the offer of credit, and the industry, whether the industry restrains it, whether regulatory authorities restrains it, somebody has to be practicing restraint, because there is a problem of people not being the best judges of how much credit they can handle. And I think that this is we've gotten increasingly in the field of behavioral economics, you see that people are not completely rational about all decisions that they make, and the decision about how much credit they can afford and can competently handle is one in which they are known to make over-optimistic projections, and you can just feel that it's your own. You share the human nature that thinks optimistically, I'm going to be able to make this work. Realistically, a lot of people who think they're going to make something work end up getting hit with something they didn't expect. So that somebody has to restrain. You can't leave it completely in the hands of the individual client just to say how much you need. So where's the restraint going to come from? It's very difficult in a competitive environment to have restraint where the competitive environment suggests that getting more market share and growing the client base are the two things that you're chasing. So, okay, that's one kind of built-in problem. Second one, public perception of interest rates. Every major religion has strictures against interest rates. It goes back thousands of years. The idea of charging poor people more than charging rich people for credit is never going to be politically acceptable. It's always going to be a political vulnerability. And I think microfinance has been living in a world in which it wasn't subjected to that vulnerability because it's been small. But as it gets bigger, it's unavoidable. Excuse me. So that's the second one. I think, and closely related to that, I would put it in the same group as poor collections practices. So individual stories of individuals who are harmed by getting into debt or being treated unfairly by collections agents. Those are always going to be great fodder for the press. The third is the political attractiveness of microfinance. That any politician that's interested in getting votes is going to look at the numbers of people, the sheer numbers of people who are connected into microfinance and say, whoa, that's a great voting block. If only I could get that voting block to vote for me. And so the political temptation is either to take it over or to turn out to be a hero by somehow making it solve all the problems, such as by putting on interest rate caps or some other kind of punitive action. And the fourth is the entry of bad players. That even if you've got a very strong sector, as I think exists here, with a lot of understanding of a social mission as well as a financial mission, it's very easy for bad players to enter, for bad players to put on the cloak of being good players, and then bad players really can have a strong effect in damaging the market. So I'm going to stop with this. This is the not hopeful picture, but we can get more hopeful from here. So this is the down at the very bottom, and let's then talk about working our way out from that. But I do think that it's important to note that these four characteristics of the vulnerabilities are ever present. They're very closely connected with the nature of the activity, and so it's very important to always be on the alert for looking at what the steps are to solve them. So that's where we'll leave it for now.